Awesome, welcome. Yeah, as I say, it's our first webinar of the year. Can't believe it's the end of January already, 2022. 1 month has flown by already. Time does fly. Yeah, and as you can see there by my title, it's tax season again. So, are you keen to learn how to pay less tax to the taxman? I presume that all you guys on this webinar are obviously interested in that scenario. So obviously the tax year is fast approaching and your window of opportunities to pay less tax will be closing soon. So we've got just over, today or yesterday, just over a month to get going. Okay, so those of you that don't know me, my name is Sean van den Berg. I'm an investment specialist here at PSG Wealth. I present these monthly webinars. It's usually the last Wednesday of every month. This webinar is being recorded, so I hope I'll be able to send it out either tomorrow or by Friday, as well as the PDF of the presentation. The idea there is for you to review, and obviously any questions you guys have, you're welcome to get back to me. There will be opportunity to ask questions within the webinar, and I'll have a slot for that. So yeah, let's get going. So as you can see, the whole idea today is to talk about tax efficient vehicles. Here's the quick agenda. Oops, sorry, wrong button. Here's a quick agenda. Okay, so we're going to talk mainly about retirement annuities and tax-free, but also I just want to bring some other stuff into it. I want to create that sense of urgency. I think a lot of people procrastinate, and before they know it, they miss opportunity. So yeah, before we get into the nitty-gritties, let us just discuss some of the important investment lessons we can say that we've learned over the last 2 years in COVID. So I've taken this from the newsletter, our PSG newsletter from asset management by Annette O'Hearn, and she basically highlighted 5 little lessons, and I'm just going to just touch on them also very quickly. And just as a side, you can see my little quote up top there, just under the title every time. So I don't want to make us too heavy or too technical. So I've highlighted some text quotes for you, just to keep it fun and interesting. But my idea today is obviously to educate you and to help you gain a great understanding of the tax efficient vehicles that we have and what you can take advantage of. So first of all, let's talk about the importance of housekeeping. So there's a difference between investing for the long term and a buy and hold strategy. If you've got a portfolio, long-term portfolio, because remember, at the end of the day, market movements will skew the allocation of your assets in your portfolio, and you need to be actively review these your obviously investment portfolio from time to time to ensure that you have not inadvertently taken excessive or insufficient risk in your portfolio. The reason I'm saying that is I see it with a lot of people with retirement annuities. They're very young and they're investing in income funds, that kind of things. So I just want to touch on that. So talking about risk, you want to manage your risks. So for investors, understanding the risks in the markets have always been important, but even more so during this, call it pandemic times, when bifurcated, that means split or divided markets, have meant that some parts of the markets are very expensive while other markets are very cheap. And we can see a lot of value funds are coming to the fore now as opposed to the growth funds. So I'm saying that is that we always have to argue that the price you pay for an asset is a key determinant of a long-term outcome you expect to achieve. But it's also important that in the current environment, it's important to ensure that you're not overexposed to some of the very popular assets or the very popular, call it growth funds. Okay, so a lot of investors have been chasing the growth funds and things like that, where performance may obviously disappoint in the future due to obviously the inflated valuations. So just be aware of that kind of stuff. And then going on that, talking about risk and things like that, it's also important to manage our emotions. So market volatility will come and go, but it's how we manage our responses to that market volatility. that ultimately will determine the long-term investment outcomes that we want to realize. So those of you, there are some people that obviously sold out at the market lows of March 2020. They couldn't handle the pain anymore. They actually turned paper losses into real ones, and they missed out on the spectacular rallies that we have seen subsequently. Okay, there's a whole cliche, time in the market is better than timing the market. But I'll come touch on that a bit later. And then lastly, obviously, or second last, is having a contingency plan. I know in previous webinars we have talked about contingency plans. You know, it should be second nature to have an emergency fund. We you can cover 6 months income or 6 months expenses at least, and ultimately maybe a year. But also, investors should be aware of the dangers of betting on a single strategy or outcome. So that's what I mean by also having contingency plans as such. So diversification remains the best line of defense to ensure you remain on track to achieve your long-term investment goals. Okay, that's what I mean by that contingency plan. And then the last one here, technology is great, but sometimes we need the human touch. So these days, investors are better informed than ever, obviously with the internet and things like that, and can manage their own investments seamlessly. Yet there is no replacing the human touch of a financial advisor. Now, I'm not a financial advisor, I'm an investment specialist. So those of you that are direct clients with us, you're still welcome to bounce ideas off us. We've got a whole team of investment specialists. Although we can't give you specific advice, you can say to me, Sean, I'm looking at this fund, what do you think? Okay, so just be aware of that. But those of you that want financial advice, we can refer you to financial advisors. Okay, so the whole idea here is having a financial advisor or having someone else look at your portfolio just helps us to manage our emotions and take a longer term view at the most difficult times. So it helps us keep a cool head, and ultimately helps us make better decisions in the long term and in the long term. So I hope that, guys, made some sense to you. Okay. So also, by the way, I was talking just now about diversification. And I'll touch on one of the other slides, the importance of being geographically diversified. We have the opportunity to obviously gain offshore exposure. So if you've got a big fund in your portfolio, or all your money's in one portfolio, maybe consider splitting it and moving into also having exposure to offshore. And I'll touch on it again just now. So why the urgency? The reason I'm saying this is that, did you know that the tax-free, we'll touch on it again a bit later, the tax-free investment plan, tax-free savings, was introduced as a incentive to encourage household savings way back in 2015. So it's been around for nearly 7 years. Do you also know that back in 2000, when they first started, 2000, the first 2 years as such, the annual contribution was 30,000. So for the first 2 years, if you had contributed your 30,000, well, it was 60,000. And then in year 2018, 19, and 20, they upped it by 10%. So it went to 33,000 a year. Okay. So if you had started investing right from the beginning, and you had, as I say, maxed out your returns, you would have 99,000. I'm just keeping it simple. That was just been your contributions. Okay. 2021, they upped it to 36,000. That was obviously another 10% on that or so. But your total contributions, if you had started just from the beginning, would have been 153,000. Okay, excluding, as I say, any growth and things like that, just to keep it simple. If you had just started with 500 Rand a month from the beginning, that's times 12 times 7 years, you're at about 42,000 Rand now, just in contributions. So the big difference is if you had maxed it out and taken advantage of it. So obviously it depends on affordability. Yes, I agree with that, but a lot of people just keep their contributions at 500 Rand. So the reason why I'm saying it's urgency, you have the opportunity now to top up your RA, your tax-free for this year. You got until the end of February, which is next month. Okay. So another way to look at it is in the 2021 year of assessment, your annual limit, as I said, is 36,000. But let's say you've only paid in 30,000. you're wasting opportunity of that 6,000 Rand, because that 6,000 Rand that you're not taking advantage of is not rolled over into the subsequent year of assessment. So in other words, there's a deadline coming up. You need to make a decision. Don't put it off. Don't procrastinate. You're wasting opportunity by not topping up. So just start. Okay, so more importantly, the sooner you start, or the earlier you start, the better. So again, start early and commit to saving. So whatever the underlying fund or investment vehicle you choose, it's important to commit to saving and starting early. In previous webinars, we have spoken about the magic of compound growth. It's a powerful force that can help you achieve your targets, but it becomes more pronounced over time. So the earlier you start, the better. Okay, so when I talk about compound growth, I prefer to use compound growth instead of compound interest, because I want the layman to understand that there's growth from dividends and other equity distributions that is also compounded over time. It's just not just interest. Okay, so I just wanted you to be aware of that. So I'm going to use the example here. We've got two investors, and this is how we can look at the magic of compounding over the long term. We've got two investors. Investor one starts investing. We'll just bring my little cursor in here quickly, my little spotlight. Whoops, my spotlight. So investor A, he starts at the age of 20. Okay, he puts 500 Rand a month away. Okay, and remember the goal here, the assumptions for both of these investors, the assumption is 10% growth per annum, and we're increasing our contributions every year by 6% just to keep up with inflation or beat inflation. And our goal is to retirement age of 65. So this guy obviously got a 45-year time horizon, okay, we're going to invest for. And obviously, yeah, we're using an RA example. So there's no tax payable within the retirement annuity structure. So you can see after that time period, you would have had nearly 8 million Rand. You would have contributed 1.2 million, and his growth and investment returns would have been nearly 8 million. Investor 2 starts nearly 15 years later, and he's putting in 2,500 Rand. So it's 5 times more. Remember, investor A, and he's putting nearly 50% less, but investor A, because of time, he's putting in nearly 5 times more, and he starts at the age of 35. So it's 15 years later, and his time horizon is now 30 years. You can see they get very close to the same kind of returns. This guy just started earlier, 15 years earlier. His contributions are 5 times less. Okay, but that just shows you the magic of compounding. So how much more would you need to save to reach a given target? You just move back this again, go back to a normal pen. So another way of looking at it is to determine or visualize. Another way of visualizing, let me use it that way. The benefit of compound growth is to consider how much more your monthly savings you would require at different ages to reach a certain target. So in this scenario, our goal is 10 million Rand. How much must I contribute? Okay, the earlier you have, again, you can see my assumptions at the bottom here, 10%, 6%, retirement age of 65. Again, I'm using example, I'm using an example of the retirement annuity. But the thing is, if I'm starting at the age of 20, I can start as little as 500 Rand. Okay, 500 Rand a month, I've got 45 years, and I should get to my target of 10 million. Okay. If I'm age of 30, you can see I'm roughly have to start at roughly about 1,500 Rand. So I've got 30 years to reach my target. Age of 40 now, okay, you can see there 5,000. The age of 45, I've only got 20 years to go. I have to put nearly 9,000 Rand a month away. Okay, remember I've only got 20 years to go. So the earlier you start, that's the point I'm trying to make. Again, I'm trying to create that urgency. The earlier you start, the better the compounding growth will work in your favor. Okay, so we spoke about compound growth. And the increased the benefit of compounding can also be used in a tax-efficient vehicle like a retirement annuity. So you got a double whammy, put it that way. So the benefits of saving in a tax-efficient vehicle like a retirement annuity or a tax-free can also add to the benefit of compounding. Okay, so whatever your underlying investment choice, it's important to reinvest your investment distributions. That is one of the key drivers to the benefit of compounding. Okay, so let's talk about retirement annuities. First of all, we'll do a quick comparison here. Who's it suitable for? Obviously, a retirement annuity is suitable for anybody that wants to save for retirement. So I believe that should be one of your priorities. But even if you've got a pension fund or provident fund, it's a nice way to supplement your existing retirement savings. One of the major benefits of a retirement annuity, you can also nominate a beneficiary on death. So if something happens to you, you pass away, that retirement annuity goes to your two beneficiaries. Okay. One big advantage of a retirement annuity is obviously any contributions you make is tax deductible. And also within the retirement annuity structure, any gains in interest or dividends or capital gains is tax-free. So you can take a third, we're talking about it just now, a third of your capital at the age of 55. You can take it as a lump sum. Yes, there are tax on it and things like that, but you can take that as a lump sum and you do whatever you want with it. The other 2/3 has to be reinvested for, call it a pension, or into a living annuity so you can have a monthly income. So when can you have access to your retirement annuity? Obviously when you officially immigrate, or you have ill health due to disability, or ill health and disability. But the main thing is you can only access it from the age of 55. Okay, most people obviously want to retire at the age of 55, or the age of 65. But the main point I want to highlight here, this is for someone that needs disciplined savings. So it's a nice way to force yourself. You can't have access to those funds before that. Okay, so that's a retirement annuity. A tax-free, it's only available for individuals who are South African tax citizens. Okay, so be aware of that. So any capital growth within that structure, any growth, dividends, and tax interest is tax-free. So there's no investment term. You can invest as long as you want to. There's no, you're not going to be penalized when you take funds out. I like to do both of them together, and we'll talk about it just now why. But when it comes to retirement, I like to be in a situation where I access my retirement, my tax-free first, because there's no tax on it, and I can pay whatever debts I have before I touch any of my retirement funds. So there's pros and cons. People have, I was talking to my colleagues earlier. There's pros and cons whichever way you want to do it. But the point is, ideal situation is to be having both investment vehicles, and ideally, obviously, maximizing your tax contributions on the RA, and then and putting as much contributions into your tax-free. That's the idea. So the idea is to take advantage of these tax incentives. These are two vehicles for you to use to pay less tax to the tax man. So what is a retirement annuity? As I mentioned just now, all your contributions up to a certain amount, up to 27.5% of your salary, it's capped at 350,000. But all those kind of things you can claim back. Okay, so any growth in it is tax-free. As I say, it's a great way to save for discipline, from a discipline point of view. You can make a lump sum, you can make monthly payments, you can also do ad hoc payments, and we'll talk about ad hoc payments a bit later. The main thing here is that with retirement annuity, you are limited to what you call Regulation 28. It's just there to protect you. That limits your exposure to too much to equity. Remember, the equity markets historically has given you the greater returns, but greater returns comes with greater risk. So you are limited up to 75% with obviously equity. So a lot of people will go balance funds. That's what we call asset allocation fund. There you're maximizing your 75%, but you're also having exposure to offshore and property and everything else. Okay. So through our retirement annuity vehicle, you have access to a lot of funds. We've got a broad range of funds you can choose into. Okay. So, by the way, the retirement annuity is great for someone who's also self-employed. Okay, so this is very important to form part of your investment portfolio, but also for someone that might have a company that does not have a pension fund or anything like that. So ultimately, this just becomes what you call an individual tax deferred savings plan. That's one way to look at it. Okay, so how much can you contribute to your retirement annuity? it's based on what they call your taxable income or remuneration, and that might include different sources, such as be your salary, your bonuses, commission, rental income, interest. All that is considered as your remuneration. So in our example here, let's say, for example, you get someone that's earning 500,000 Rand a year. John is 40 years old. He's earning 500,000 Rand. This is the only income he's got. So I'm not going to complicate it with rentals and things like that. So John earning 500,000 Rand a year. You would like to contribute his maximum deductible, what is maximum deductible to his retirement annuity per year. So in this scenario, it's capped at 350, but remember, it's 27.5% of his 500,000. So in this scenario, in our example, the most you can contribute to take advantage of the tax is 137,500. Okay, I'm going to look at some more examples. Yeah, we've got an example of John and Adam again. So John is employed by ABC company and earns a salary of R1 million per year. Okay, he's not a member of a pension or provident fund. He contributes 350,000. Remember, that's what it's maxed out. That's what much you can do to RA fund. There's no other taxable income is coming in. So the receiver says, okay, his remuneration is R1 million. So I'm going to play a little game with you. How much can he claim? Okay, so is it 27.5% of his of R1 million, which is 275, or is it that 350 his contributions, or is it his whole R1 million? The trick question, the most you can deduct from tax is 275. Okay, so I hope you guys understand that scenario. Number two, yeah, we got an example of Adam. He earns a cash salary of 420,000 Rand per year. His employee contributes 30,000, okay, on his behalf to a pension fund. So his total remuneration is 450,000. So he also contributes 30,000 to a pension fund. So the total retirement contribution is 60,000. That's what he does every year. Okay, now the income comes in. How much can he deduct from tax? Okay, is it at 27.5% of that 450, which is 123,750, or is it the max, the capped 350, or is it the 450? No, it can only be what he actually contributes, the 60,000. And again, comes back to what I said just now. You're wasting opportunity if you're not maximizing that your tax deductions. So the more you put into your tax-free, or more your RA, the better. You're wasting opportunities there. Again, I want to create that urgency for you. So I just want to go back to this example, by the way. So he's putting in 350. He's only getting 275 benefit from tax deduction. That other 75,000. What's happened about that? Yeah, obviously it goes to his capital at retirement capital. So you can carry that 75,000 forward to the next year, okay, as a disallowed contribution, and obviously that will add to the next year. It also lowers the lump sum at retirement, and also reduces the tax portion of his annuity income. So you're not going to miss the opportunity, but I just think now you're wasting opportunity. That's 75,000. Rather put into a 36,000 into a RA, into tax-free to maximize that. I hope that makes sense for you guys. Okay. So let's look at the fees. You can see on the retirement annuity, I don't go too much into this. You can see PSG funds up to R1 million, 0.35%. Any other funds, much higher. That difference doesn't sound a lot, but compounded over, let's say, 30, 40 years, that's a lot of big money you can save there. Okay. So you can see the list available, and this is on our website. You can go onto our website. This is just using example of the PSG funds. You can see how they're all split up. But this is how you can see for RA, I highlight for you which funds are Regulation 28 compliant already. And also highlight for you which funds are available for tax-free. And so on our website, you'll be able to look at all these different funds. So just how you can see, obviously, all these other funds don't apply. Ignore them. So what you do is you click on those, on the links, and it gives you, takes you through to what we call the fact sheets. You can learn more about the funds. Okay, and that's how you can educate yourself. What about a tax-free investment plan? So as I mentioned just now, they've been around for more than 7 years now. The idea here with a tax-free is that I would say it complements your retirement annuity. So yes, you are limited to 36,000 a year. At this point in time is obviously 30,000 a year, 3,000 a month. Okay, just understand there's also a lifetime limit. That's 500,000 over the entire life. So that's 36,000. They might increase those contributions every year, but that lifetime, that 500,000 doesn't change. But if you had to reach your limit of 500,000 and you withdraw 50,000, remember you can't put that 50,000 back at a later stage. That is one of the limitations you have here. So it's a nice way to think of yourself, this is a long-term investment. And again, don't invest into a income fund or a money fund, because you might as well put your money in the banks. Your first offhand, I can't remember what the interest is, but your first, I think it's 26,000 or 28,000 of interest you earn is tax-free anyway. So you're wasting opportunities if you put in that kind of money into a fund for that. Okay. Again, I just want to highlight for you the difference, the tax advantage or investing in a tax-efficient vehicle compared to putting your money into a voluntary investment plan. You can see the differences if you're investing in a tax-free at 10%, 12%, or 15% over various periods of time, how the tax advantage kicks in. Okay, so just be aware of that. You can invest in the same funds in a voluntary investment plan compared to a tax-free. The tax-free, because of the tax benefit you're getting, it will help you also compound. Again, you can see the fees involved here. This is PSG fund, 0.3%. There you got 0.5%. So just over, just under 0.2%. Those 200 pips compounded over a period of time does help you. Okay, so consider those PSG funds in your portfolio. Okay, so guys, I've gone out very fast on this. Got 2 more minutes to go. But just to highlight, as I say, that sense of urgency. The deadline's end of February. Those of you that do want to make additional top-ups, remember the money must be in our account by Monday the 28th. So I suggest the latest you transfer the money is the Thursday or Friday, the 24th or 25th of February. Okay, so take advantage of those tax incentives and top up. Okay, so a quick summary on the retirement annuity is great for disciplined savings. There's also for prudent savings. Tax-free, I believe, is a buffer, because I suggest, if you're saving your contributions over those 15-year period and whatever the case might be, use those funds first before tackling your retirement annuities and living annuity money. Okay, so that's what I mean by it's a buffer or first defense. Okay, let's see what kind of questions you guys have. Okay, let me see what questions you guys have. There's a question from Johan. Says, can I transfer from my VIP to my RA? Not directly, Johan. So what you need to do is obviously sell out those units, move into cash, and from cash, move it into a retirement annuity. Okay, but obviously you also understand that there might be CGD implications on your voluntary investment plan. Okay, I forgot to mention earlier on. That's not to give us as a theoretical question for you guys to think about. There's a saying, and I mentioned just now, that time in the market is valuable. Now, what if those of you that are very young parents, what if you got a 1-year-old, and what if you opened a retirement annuity in your child's name, that 1-year-old? Okay, and you are contributing to that retirement annuity. But let's say instead of doing monthly, let's say you take 1 month's salary, be it 20, 30, or 40,000, and you invest that lump sum into that retirement annuity. So yes, you won't be getting the tax advantages, but let's say you invest that lump sum for your child's retirement annuity. Remember, that 1-year-old has got 55-year investment time horizon ahead of them. And let's say, for example, theoretically again, that investment grows by 10% per year over 55 years. Okay, imagine you're starting your child off. When it comes to their retirement, they don't have to worry about at the age of 55, they don't have to worry about anything. You've taken a big chunk out of their saving, out of their contributions for them. Okay, just think about it. There's no need to open up what we call a testamentary trust for them, because remember, they can't access those funds at the age of 55. So that was just something interesting that came up with discussions with my colleagues this morning. Opening up a retirement annuity for your 1-year-old. Okay, so think about that. So let me see what other questions you guys have here. A minimum top up into my RA. There's a minimum, yeah. There's no minimum top up. No. Why no, man? There's no minimum top up. So obviously you want to take advantage of your full 27.5% of your salary. So that's why I said, look at your salary. If you're earning 500,000 times 27.5%, that's the most you can take advantage of from a tax point of view. But there's no minimum top up. No. Okay, I hope that made sense. Yeah, the tax free at this point in time, it's still 36,000. We are here obviously in the budget speech next month, but that'll be for obviously the 22 tax year. But at this point in time, it's still 36,000 rand. Okay, so if you still got opportunities to top up, then go for it, Vessel. Top up. One out of con, yeah. Obviously, that was right in the beginning. Anyway, guys, looks like those are all the questions. I don't go too much over time. So just quickly summarize. Any questions you guys have, you're welcome to drop me a email. You can drop it to the wealth box at psg.co.za. You can also phone us on our one stream number there, 0868 000 368. And there's 3 of us that can answer your questions. But from my side, guys, as I say, this is being recorded. I should be able to send it out either by latest Thursday or Friday, and as well as a PDF. But if you want to know more about the tax-free, or those of you that haven't got a tax-free or retirement annuity, go into our website. He has a link to the website. Get a hold of what we call the key information documents. Educate yourself about the products. And then we go register and open an account. Takes 2 working days. Do the whole FICA process. Once that's all done, and then we're there to help you in the process of selecting underlying funds. As I say, we can't tell you what to buy, but we can help you with the tools available on our website. So, guys, thanks from my side. I hope this presentation was beneficial. The first one of the year. Hope you've learned something. So, from my side, bye for now.